Hi, this is your interest rate watch for Tuesday, October the 19th. Yesterday we mentioned that the independent Federal Reserve board members were going to be interviewed throughout this week. And in fact, yesterday, the Atlanta Fed President, Dennis Lockhart, was interviewed, and he was quoted for saying that the purchase program could be up to $100 billion per month. Now, for homeowners out there, let's put that into perspective. If you can recall, in 2009, the Federal Reserve put out a total of $1.2 trillion to be purchased, basically from February of 2009 all the way up until the end of March 2010. Now, what this accomplished is stabilizing interest rates, keeping them low. Now, think about if they do put out another $100 billion, if they do go for another 12 months, obviously that's going to be another $1.2 trillion. So it is still speculation on what's going to happen. Now, as far as interest rates, if we saw these lows last year with that initial program and rates have been hovering at these levels without the actual buyback program in place, then we could potentially see the pressures to push interest rates lower. Now, how much lower? We're still going to wait to see without making too much of a speculation. But what we're hearing from the banks, from the economic advisors of the banks, the lenders that we're working with, is that their top and chief people are saying that interest rates could reach the levels of the high threes. Now, we've seen that already a few times this year, and it could potentially come as a form of a 30-year fix being possibly even 3.5. Now, without putting out there what the APR, the fees, the discount points, that is still all just, there's just a mix and recipe on how that's actually come to play. But the national average, if you look at what the national average is today at the 4.374, it could potentially be pushed lower. So we're going to leave that out there, but it does make for a very exciting November 2nd and 3rd meeting that's coming up here, and really everything that's going to lead up to it. Now, how the bonds are reacting today for homeowners out there and future and potential homeowners is that we're actually starting to see it work against us. And in the last 5 business days, we've actually seen interest rates trickle up higher. Yesterday we opened up good, we closed good, but today we're already starting to see it fall off. And again, really in a quick point, what we want to reiterate is we're going back to the model every single time of, let's just take hypothetically an interest rate of 4.5. Let's say on a good day when the bonds are reacting well and the mortgage-backed securities are reacting well, for homeowners, if you're at 4.5, there's a potential that you might not be paying any closing costs. Now, the reverse side of that, if interest rates or the bonds sell off and we have a bad day on our side in the mortgage world, then that same rate of 4.5 could potentially have a loan origination fee / points, and then some closing costs. And then, let's say hypothetically, if we have another bad day, then all of a sudden you're looking at paying all closing costs and potentially a discount point to buy the rate down. So, when we do talk about interest rates for education purposes, it's not that interest rates are moving from 4 to 5% overnight. What we're really talking about is capturing the best financing opportunities for you. And what we mean by that is it's all individually based. Everyone's always going to say, I got the lowest rate. But really, in this market today, the lowest rate is based on your finances and where you feel it's best structured. For some people, it's not paying a loan origination fee / points. For some people, it's paying no closing costs at all. And for others out there, it really just comes down to, when does it make sense? A lot of people are still sitting in the high 5% range and still have not refinanced because they just don't want to go through the aggravation of paperwork and everything it really entails. But really, we want to put out there that if you're saving 1%, if you talk to a CPA and financial advisor, your break-even point in most cases, and then this is a generalization, in most cases is going to be less than 18 months. Now, if you're dropping it more than 1%, then obviously your savings are dramatic, and depending on your loan amount, that could be hundreds of dollars a month. So it's just something to keep in mind for the education point. But obviously, this is all leading up to the November 2nd and 3rd meeting to see how the market's going to react, what the actual buyback program is going to look like, and again, what the dollar amount is going to be. Stay tuned. Make sure to follow us on our Facebook and Twitter page as we put more updated posts in case we have breaking news throughout the day. But we'll be back tomorrow.